Hey everyone, and welcome. So, when you hear the word bank, what comes to mind? Probably one of those huge commercial giants, right? Well, today we're going to pull back the curtain on a totally different part of the financial world, the places that were actually built for people like you and me.
Have you ever stopped to wonder why a credit union isn't just called a bank? Or heard whispers about this huge savings and loan crisis? We're going to get into all of that. We'll explore the story of these institutions that were designed for the everyday person, and you'll see how their story directly impacts the financial choices you make right now. All right, so to really understand what's going on today, we have to rewind the clock. Way back, to a time before these massive commercial banks were on every corner. We're going to look at a group of institutions that started with believe it or not, a really noble purpose. And this group has a name. They're called thrift institutions, or just thrifts for short. And they were created with one single clear mission: to help out the working class. Regular folks who maybe only had a little bit of money to put away. And this, right here, shows you the huge difference. On one side, you had the big commercial banks. Their main game? Lending to businesses. But on the other side, you had the thrifts. They were all about you, the consumer. They were there to help everyday people save up and, this is the big one, buy a home. And you know what? For like a century and a half, this model worked fantastically. From the very first savings banks way back in the day to these groups that literally pooled their money to help each other buy houses, thrifts were basically the engine of the American dream. They were a huge reason for that massive boom in homeownership right after World War II. But, and there's always a but, isn't there? Buried deep inside this simple, noble business model was a critical flaw, a kind of ticking time bomb, really. A weakness that, when the economy got squeezed just right, would turn out to be, well, catastrophic. So here's how their whole business model worked. It was super simple, actually. It's called borrowing short and lending long. Step 1, they'd take in your savings deposits, that's the short-term part, and pay you a pretty low, stable interest rate. Step 2, they'd turn around and use that cash to give out long-term home loans, 30-year mortgages, at a fixed rate that was a little bit higher. And that difference, that little gap between what they paid you and what they earned from the mortgage, that was their profit. Simple. And for decades, this was a rock-solid, predictable business. But the whole thing, the entire system, hinged on one crucial assumption: that the cost of those short-term deposits, the interest they paid to savers, would always be lower than the income they were getting from those long-term loans. But what happens if that flips? What happens if the cost of their money suddenly goes through the roof? Well, that's the question that's about to blow the whole thing up. Okay, so fast forward to the late 1970s and early 80s. This is when that what-if question stops being hypothetical. A perfect storm of economic chaos hits, and the entire model just breaks. To fight crazy high inflation, the country's interest rates just exploded. They shot up to levels nobody had ever seen before. All of a sudden, thrifts had to start paying way, way more interest to their savers. If they didn't, people would just pull their money out and stick it somewhere else that paid better. They were trapped. And this graph, wow, it shows you exactly what happened. Just look at that insane spike in interest rates. It's practically a vertical line. For the thrifts, this was a nightmare. The cost of their money, the interest they had to pay out, just went through the roof almost overnight. And here's the direct result of that spike. This chart shows what it did to their bottom line. Remember, their income was stuck. It was coming from all those old mortgages with low fixed rates. But their costs, they had just skyrocketed. That simple profit margin they relied on, gone. It was completely wiped out, and they started bleeding money. We're talking massive, industry-wide losses. The fallout was just devastating. Over 1,000 of these institutions went under. And the final price tag for the government bailout? An estimated $124 billion. It was a crisis so big that it completely changed the rules for banking in America. But what's interesting is that not all thrifts went down. There was another type of institution, one you're probably familiar with, the credit union. And they mostly weathered the storm. And that's because their entire reason for being, their whole philosophy, is totally different. So what is the credit union difference? Well, for starters, they're not really a business in the traditional sense. They are nonprofit cooperatives. And get this, they're literally owned by the members, the people who have accounts there. That structure is a game changer. It means they're not trying to make a profit for shareholders, and it gives them some big perks, like not having to pay federal income tax. And that idea of being a mutual institution, It changes the entire goal. The whole point isn't to squeeze out profits for some investors on Wall Street. Nope. The goal is to serve the members, the owners. That's why they can often offer better interest rates and lower fees. It's a completely different mindset. Okay, let's switch gears completely. We're going to talk about another major player in the lending world. But this one, it doesn't need our savings deposits at all. Let's talk about finance companies. And that right there is the key thing to know about them. They are not depository institutions. So, if they're not taking in our savings, where in the world do they get all the money they lend out? Well, they go to the big leagues, the capital markets. Their main way of raising money is by using something called commercial paper. The easiest way to think about it is like a short-term IOU from a big, reliable company. They sell these IOUs to other large investors, along with other kinds of debt, and that's how they raise the cash to make loans. And this chart lays it out perfectly. Thrifts and banks, they get their money from our deposits. Finance companies, they bypass that completely and go straight to the capital markets. It's just a totally different plumbing system for money.
And these finance companies come in all shapes and sizes. You've got your consumer finance companies that give you a personal loan. You've got business finance companies that help a small business lease equipment. And then you have what are called captive finance companies. Think Ford Motor Credit or Toyota Financial Services. Their entire job is to help you get a loan to buy their parent company's car. Okay, so after all that, why does any of this history matter today? Well, it matters because understanding where these different institutions came from, their original purpose, what broke them, what made them strong, it explains the financial world we live in. It's why you have so many different choices when you need to save, borrow, or finance something big. Think about it. You've got the legacy of the community-focused thrifts, you've got the member-owned, cooperative model of a credit union, and you have the sheer power of a finance company that's funded by the markets. Each one of these was born to solve a specific problem, and they all still play a really unique part in our economy. So, how does all this history show up in your life? I mean, think about the bank you use, or the credit union down the street, or the loan you got for your car. The DNA of these institutions and the lessons learned from that massive crisis are still shaping the financial world we all have to deal with every single day.